What's up? Japan Market Samurai, broadcasting fresh updates straight from Japan. Let me ask you something. You're not seriously thinking, Japan's market dropped. Time to sell everything, are you? Or worse, maybe this whole rally was just another bubble. Because if that's where your head's at, you might be about to make one of the biggest investment mistakes of this cycle. Today's dip, it's not a breakdown, it's a setup. And those who recognize it early, they're going to front run the next wave of global capital rotation. Now I know what you might be thinking. This kind of timing, only pros can catch that. It's all about instinct and experience, right? Wrong. Understanding market pullbacks, sector rotations, and macro triggers isn't some magical sixth sense. It's a repeatable framework. And once you see it, you can start trading strategically, not emotionally. It's not about guessing the top. It's about knowing why the market moves and when to act. Imagine this: you wake up, check your portfolio, and instead of panic, you're calm. Why? Because even when the Nikkei drops 500 points, you already knew it was coming. You've positioned yourself in the right sectors and you understand the macro play. You're collecting dividends from domestic value stocks. You're watching capital flow toward your positions. You're not chasing, you're anticipating. Feels different, right? That's what investing with structure looks like. But maybe right now, you're feeling stuck. You hear Japan is rising, but you don't know why. You're nervous every time the yen moves. You can't tell if -1 tomorrow tomak means -1 tomorrow percent means buy the dip or run for the hills. And honestly, that confusion isn't your fault. You've been sold a story that markets only go up and red candles mean danger. But let me be blunt, if you're still reacting emotionally to every headline, if you're still following hot takes instead of macro flows, you're not investing, you're gambling, and it's time to stop. I don't have time to track all this. I'm not an economist. I'll just wait and see. No, that kind of passive thinking, it's exactly why most investors underperform. Here's the truth. You don't need to predict the future. You just need to understand how capital behaves and build your edge around that. Once you do, the market gets a lot less noisy and a lot more profitable. Look, I started out confused too. I made panic sales, I chased rallies, I thought strategy meant finding the next Tesla. But once I started decoding Japan's structural shift, the policy moves, the valuation gap, the capital flow logic, everything changed. Now I don't react to dips. I plan for them. I use them. And if I can do it, you definitely can too. What I'm about to walk you through in this video is not surface level commentary. It's first source macro validated analysis that institutional players use, made digestible for everyday investors. This isn't financial fluff. This is the real blueprint behind the Nikkei's rise and where the smart money is heading next. So if you're ready to stop playing catch up and start playing ahead, smash that subscribe button right now and let's get into it. Because Japan's not slowing down, it's just getting started. Step 1. This was a textbook healthy pullback. Conclusion. This isn't a breakdown, it's a reset at the top. Today's 1.74% drop in the Nikkei isn't the start of a collapse. It's the market doing what strong markets are supposed to do, cool off after hitting a new high. It's the kind of move that clears out weak hands and creates space for the next leg up. In short, this was a healthy pullback, not a warning sign. Reason why markets need these pullbacks. Whenever an index reaches record territory, profit taking is inevitable. That's just market gravity. You can't have a straight vertical rally without corrections, and if you do, that's usually a bubble. What we're seeing now in Japan is different. The Nikkei just made all-time highs on October 30th. It ran hard fast. A pullback at this point is not only expected, it's necessary. Why? Because this kind of correction allows for sector rotation, rebalancing, and confirmation of the underlying strength. Also, keep in mind the psychological shift. When investors sell after big gains, it's not fear, it's discipline. They're locking in profits, reloading, and positioning for the next move. That's not a breakdown. That's smart money behavior. Example. The numbers and behavior behind the move. Let's look at the facts. The Nikkei opened at 52,294, surged to 52,636 by mid-morning, and then reversed hard, closing at 51,497, nearly the low of the day. That's a clear intraday fade, but not due to any single catastrophic event. What triggered it? Three main things. Technical overextension. The index had extended well above short-term moving averages. A pullback was baked in. Macro headwinds. The yen bounced slightly on verbal intervention hints, and investors braced for potential BOJ tightening commentary. But notice something critical. There was no panic selling, no major shift in fundamentals, no collapse in breadth. In fact, the broader topics index hit a year-to-date high in the morning, showing internal strength. What does that tell us? The sell-off was concentrated, not systemic. Summary: pullbacks like this are opportunities, not threats. Here's the bottom line. When markets sell off after reaching new highs, most retail investors get nervous. But professionals, they get interested. Today's move was a textbook reset. No collapse in macro outlook, no deterioration in earnings, no breakdown in sector breadth, just profit taking after a vertical run. If anything, it creates an opportunity to enter names that just got cheaper, or to rotate into sectors poised to benefit from the next wave. The key is to stay objective. This isn't the time to panic, it's the time to prepare. Because healthy markets don't go straight up, they breathe. And right now, Japan is simply taking a deep breath before what could be the next major leg higher. Step 2. Tech took the hit, and that's a good thing. Conclusion. The tech drop isn't weakness, it's rotation. What we saw today in Japan's market wasn't a meltdown of confidence, it was a sector rotation in progress. High-priced tech names led the rally, and naturally, they're leading the pullback. That's how healthy markets evolve. Leadership changes hands, capital redistributes, and the trend becomes more sustainable. So when you see names like SoftBank or Vantage falling, don't assume the market's over. Instead, understand this as the market breathing and rebalancing. Reason why the sell-off in tech is actually constructive. Let's break this down logically. Japan's recent rally has been powered primarily by a narrow group of high-beta tech names. When markets depend on a small cluster of expensive stocks, risk concentration grows and corrections become sharper. That's exactly what happened today. These stocks had run too far, too fast. Valuations stretched, momentum peaked, and investors took the chance to secure gains. But here's the key insight. The profit-taking was tactical, not emotional. Investors didn't rotate out of Japanese equities altogether. They simply shifted into areas with better risk/reward balance, value stocks, domestic demand plays, and high dividend names. This is the hallmark of a maturing bull market. It's no longer about chasing hype, it's about positioning for durability. When leadership broadens beyond tech, it means the rally is becoming more inclusive, and that's what sustains long-term upside. Example, the data and market behavior tell the story. Here's what the day looked like in numbers. Vantage, one of the market's recent high flyers, saw notable selling pressure. SoftBank Group, another heavyweight, also faced profit-taking. Because the Nikkei is price-weighted, these large declines magnified the overall index drop. However, and this part matters, top picks actually hit a new year-to-date high in the morning before easing back toward the close. That means investors didn't abandon Japan as a theme. They simply reallocated from overbought tech to undervalued sectors. Meanwhile, defensive and domestic-oriented names like consumer, utilities, and financials held steady or even ticked higher. This is exactly what you want to see in a high-quality market correction. Weak hands shaking out, leadership rotation, broader participation underneath. So while the headlines scream tech crash hits Nikkei, the real takeaway is structural resilience. Summary: a market rotating, not collapsing. Let's be clear, this wasn't a signal to run. It was a signal to observe where the money is moving next. When markets mature, they rotate. That's how new trends form. Today, capital is moving out of high multiple tech into stable, cash-generating companies. And that's a good thing for the long-term health of Japan's market. In every bull cycle, you get this moment where the flashy leaders take a break and quieter performers start catching up. That's how sustainable rallies form. So the next time you see the Nikkei drop on tech weakness, don't fall for the panic narrative. Recognize it as the reallocation phase that separates emotional traders from strategic investors. This isn't the end of Japan's story, it's the evolution of it. The smart move now is not to fear the rotation, but to follow it. Step 3. Macro moves matter. Watch FX and BOJ. Conclusion: the yen and the BOJ are setting the short-term direction. If you're serious about tracking Japan's market right now, you can't just watch price charts. You need to monitor two macro levers that are moving everything beneath the surface: foreign exchange and the Bank of Japan. Why? Because Japan is now macro-reactive in a way it hasn't been for years. Every whisper of rate policy or yen movement sends ripple effects across sectors. And if you're not tuned into these signals, you're not seeing the full picture. Reason, effects, and central bank expectations shape investor behavior. Let's talk mechanics. The yen's trajectory against the dollar isn't just a currency story, it's an earnings story. A weaker yen boosts exporters, inflates revenue in yen terms, and lifts stock prices, especially in large-cap manufacturers and global brands. But when the yen snaps back, even temporarily, it creates volatility. And that's exactly what we saw today. USD JPY traded between 153 and 154.48, a wide intraday range, largely driven by speculation around verbal intervention from Japanese authorities. That kind of whiplash puts investors on edge. Now add the BOJ to the mix. Recent commentary from Governor Ueda hinted that a rate hike may come as early as Q1 2025, depending on inflation and currency levels. Markets are now trying to price in something they haven't had to think about for decades: a potentially hawkish BOJ. That's creating tension. Growth stocks get hit harder when yields rise. Sectors that are more rate sensitive, tech for example, are feeling that pressure first. In other words, FX and BOJ language are now the real-time pulse of Japan's market. Examples how today's FX and BOJ moves impacted the market. Let's get specific. Early in the day, the dollar was firm, the yen was weak, and the Nikkei opened strong. But when Tokyo officials made noise about watching currency movements closely, the yen reversed slightly, and tech stocks began to retreat. That wasn't a coincidence. It was a direct reaction to FX volatility. At the same time, traders began to reassess their timeline for BOJ tightening. Would rate hikes come sooner than expected? If so, what would that mean for liquidity, valuations, and risk appetite? This uncertainty hit high beta names first, and since the Nikkei is heavily influenced by these stocks, the overall index pulled back sharply, even though the broader economy hasn't changed. You're not watching a fundamental collapse. You're watching the market price in macro expectations in real time. Summary: read the macro signals or fall behind. Here's the key lesson. If you want to understand where Japan's market is going, day to day, week to week, you need to watch FX volatility and BOJ signals like a hawk. This isn't about predicting exact yen levels or policy decisions. It's about interpreting direction and sentiment shifts before they fully show up in price. When it snaps back or volatility spikes, that's your early warning. When the BOJ shifts language even slightly, risk sentiment changes immediately. This is the new Japan, structurally strong but tactically driven by macro flows. And those who understand how currency and central bank narratives ripple through sectors, they're going to stay 2 steps ahead of retail money. Don't guess what happens next. Listen to what the macro is already telling you. Step 4. Zoom out. Japan is still the global hedge. Conclusion. Japan remains the most underpriced developed market. Let's take a step back from today's pullback, from the headlines, and from the tick-by-tick noise. Because when you zoom out, one thing becomes clear. Japan is not just rising, it's being re-evaluated. This isn't the Japan of the 1980s bubble. It's a country that's undergone structural transformation, and the global market is just beginning to wake up to it. So even after a red day like today, Japan remains one of the smartest long-term plays on the board. Reason, structural reform, and capital rotation are driving this rally. Here's the truth. Japan's rally isn't just about cheap valuations. It's about deep, systemic improvements that are now being priced in after decades of being ignored. We're talking about corporate governance reforms that reward shareholders, permanent NISA expansion that supports domestic equity inflows, capital efficiency mandates that push companies to deploy a geopolitical shift that positions Japan as a safe manufacturing base amid US-China decoupling. Now add this to the mix. The US market is increasingly expensive. Investors are beginning to rotate out of overpriced tech and into undervalued stable economies. And Japan, it checks every box for institutional capital looking for growth with discipline. So when we say Japan is becoming a global hedge, we mean this. It's no longer just a regional story, it's a pillar in the new capital cycle. Example, valuation, policy, and global positioning all support the case. Let's get concrete. Japanese equities are trading around 20x forward earnings. Meanwhile, US tech averages 35 to 40x, and some names are pushing 50 plus. That makes Japan not just cheaper, but far less fragile to rate shocks. Then there's policy. The Japanese government is finally aligned with market incentives, encouraging transparency, rewarding dividends, and pushing for productivity. From a capital flow perspective, money is moving, round. Foreign inflows into Japanese ETFs and stocks have been rising, round. Currency-adjusted returns are now attracting US and European institutions. Hedge funds are starting to use Japan as a rotation trade from overbought US sectors. And geopolitically, Japan benefits from being outside the direct line of US-China confrontation, hosting robust supply chains for tech, semiconductors, and autos, a favorable demographic shift toward investor-friendly policies. Put simply, there's a macro, policy, and valuation trifecta at work here. Samaru, this is not a bubble, this is a revaluation story. Let's wrap this up. The pullback you saw today, it's noise. The real story is what's happening under the surface, a full-scale repricing of Japan in the global equity landscape. Smart money doesn't chase headlines. It hunts for asymmetric risk-reward, and right now, Japan offers that in a way few other developed markets can. This is why you'll hear some bold projections. Nikkei 100,000 by 2050. It may sound wild until you look at the math, the macro, and the flows. Then it starts to make sense. So don't get shaken by a red day. Zoom out. Look at the structural momentum. Because while everyone else is focused on what happened today, the smart investors are already positioning for what comes next, and Japan is where that story is quietly unfolding. Overall wrap up. You're not late, you're early. So, here's what we've uncovered today. Japan's market didn't crash. It pulled back after a record-setting rally. That dip, it wasn't fear. It was capital rotating, resetting, and repositioning. Tech names got hit? Yes, but that's exactly what happens when leadership rotates. The macro is driving sentiment now. The yen, the BOJ, global capital flows. And through all of that, Japan remains fundamentally strong, structurally reformed, and globally underpriced. If you're still watching this video right now, then you already know you're not part of the noise. You're part of the 1% that wants to understand what's next, not react to what just happened. That's how long-term winners are made. Let me put this plainly. If you start building positions in Japan's market now, not all in, not recklessly, but strategically, you're going to look back 10 years from now and realize this was the turning point. Because while the world is still crowded into overvalued US tech, Japan is sitting here with strong balance sheets, rising dividends, improving governance, and favorable macro trends. You don't need a crystal ball. You need time. You need discipline. And you need to be early, not perfect. The next decade belongs to investors who can think globally, see structure, and ride the macro wave. And Japan, it's the market that checks all the boxes. Get in before everyone else figures it out. That's how wealth is built. Quietly, strategically, over time. Review, let's break it down one more time. Quick recap before we go. Step 1. Today's dip wasn't a collapse. It was a textbook, healthy pullback after new highs. Round to step 2. Tech names took a hit, but capital simply rotated to more stable, value-driven sectors. Round to step 3. The real short-term driver is macro. Watch FX and BOJ signals carefully. Round to step 4. Japan isn't in a bubble. It's in a structural revaluation, backed by real reform and global positioning. This isn't about reacting, it's about recognizing the deeper trend. And if you can stay focused while others chase headlines, that's your edge. If this video helped to shift how you see Japan's market, hit that like button. It tells us what content really adds value. And if you want to keep leveling up with macro first, data backed, no hype analysis, subscribe to Japan Market Samurai right now. We post weekly insights with first source data, global context, and clear frameworks you won't find in the headlines. Most people watch once and forget, but those who watch again take notes and internalize the logic. They're the ones who win over time. So ask yourself, do you want to scroll like everyone else or study like the top 1%? You know the answer. I'll see you in the next one.